Priyanka, we've got to take a look at the US markets, and a slight pullback is what we're seeing largely when it comes to Dow as well as the S&P 500.
Morning, Shanti. Absolutely. Looks like we've got a weak set of cues from US, at least now the Dow and S&P 500. They both slipped from their recent records high. Let's not forget that both the indices have been on a spree to make records. In fact, yesterday also they were, Monday also they made a fresh record high. Now, there was some sort of pullback. Both the indices lost close to same mark they lost, nearly 0.75%. Nasdaq lost 1%, though Nasdaq is still less than 2% from its record high. Now, tech stocks, majorly the semiconductor stocks in particularly, they weighted on the S&P 500 and Nasdaq. Tech sector itself slid 1.8% on Tuesday, and with that, Nvidia fell more than 4% yesterday. Talking about the earnings report, which has been mixed so far this week, with solid reports coming in from major banks. That was, in fact, the early signs which we got from banks, and that lifted the market sentiment last week also. But now that has been somewhat offset by weak outlook from firms like United Health Group. Now today, Morgan Stanley as well as Abbott, they are two notable reports which are due out before the market opens there today. Shanti.
Well, absolutely, and there's a lot to watch out for when it comes to the US markets, but in fact there's also a lot to watch out for when it at least comes to the oil prices, because when you take a look at US crude futures, you're looking at a decline coming in of just about 4%, and that's the sort of move that we saw coming in. So quite the plunge when it comes to US crude. Oil did pull back from those October highs as well. When you take a look at price levels, then you're looking at WTI, a downtick of about 4.4% coming in, or $3.2 thereabout. $70 per barrel is where that one was at. When you take a look at Brent as well, you're looking at a decline, similar decline coming in of about 4.1% coming in for Brent as well. Year to date, that benchmark has also declined more than 3%. So that's the update there, and this of course is after Israel also reportedly told the US that it is not planning to strike Iran's oil facilities, relieving fears that a major supply disruption in the Middle East is on the horizon. Now, this is something that the market was really watching out for, and this is something that had kept the oil market on its toes. So that is something that we were watching out for. Now, of course, oil prices, like I mentioned, have pulled back significantly from the highs reached on Iran's October 1st attack as well. Israel has, of course, refrained from hitting back so far, and that is the kind of move that we've seen, at least when it comes to oil. When you take a look at gold as well, you're looking at gains coming in on the flip side though for gold. So you do have a 0.6% uptick coming in for gold, but that largely is the handover when it comes to oil as well as gold.
Absolutely. In fact, that was a major headline which came in from the macro front, from the global environment. But then let's move on. Keeping it with the oil only, as is a top story, according to the International Energy Agency, world oil market is headed for a sizable surplus in the new year, as it reassured markets that the agency stood ready to act if required to cover any supply disruptions from Iran. Now, the agency, like OPEC, has already cut its global demand growth forecast for the year, citing weakness in the China. Now, the Paris-based agency now expects Chinese demand to grow by only 150,000 barrels per day in 2024, after consumption dropped by nearly 5 lakh PDP in August, which is comparison to the last month of last year, same month for the last year. Now, the fourth consecutive month of decline this particular news marks with.
Well, absolutely, and let's kickstart our coverage this morning then with commentary coming in from the Federal Reserve. Atlanta President Raphael Bostic said he penciled in just one more interest rate reduction of 25 basis points this year when he updated his projections for last month's US Central Bank meeting. However, he also added that his projections are not set in stone and that approach will continue to be data dependent in the days to come as well. Meanwhile, when you take a look at commentary coming in from San Francisco President Mary Daly, she also talked about how 1 to 2 more rate cuts this year might be on the cards, while noting that even with last month's rate cut, monetary policy is still working to bring inflation pressures down. Now, Daly also believes that the current Fed stance is still restraining the economy. So that largely is the kind of commentary that we're getting this morning, Priyanka, from the Fed.
All right, and meanwhile, according to the New York Fed report, Americans no longer expect higher inflation over the longer run, as their expectation of credit turbulence rose to the highest level since April 2020. Now, the report said that the inflation a year from now is seen holding steady at 3%. 3 years from now, it was seen at 2.7%. From August, 2.5% estimate, and at 2.9% in 5 years, from 2.8% in the August. This is all fine. These findings are from that survey. Meanwhile, the report found that expected credit delinquency rates continued to rise and hit the highest level in over 4 years.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.
Hyundai Motor India Limited now proposes an initial public offering of its equity shares. The 100% book built offer is being offered at a price band of Rs 1,865 to Rs 1,960 per equity share of face value of Rs 10 each. The anchor investor offer period opens and closes on Monday, October 14th, 2024. Offer opens on Tuesday, October 15th, 2024. Offer closes on Thursday, October 17th, 2024. For risk involved and other details, please refer to the red herring prospectus, which is available on the website of the company, SEBI, BRLMs and the stock exchanges.